Okay, I think we can start now. Good afternoon, everyone. It is my pleasure to welcome you to the 15th edition of the Aluko and Oyebode Fintech Insider Series. In this session, we'll be discussing a very important topic, tax compliance essentials, navigating new tax obligations under the new tax regime by Fintech Startups. My name is Agbada S. Agbada. I am a senior associate with the law firm of Aluko and Oyebode. I'm in the dispute resolution and tax practice of the firm. And today I'll be your moderator. The Aluko and Oyebode Insider Series is an initiative of the firm's fintech and startup practice. It was initiated to drive and shape conversations around issues that affect the fintech and startup ecosystem in the country. In our previous editions, we've had the privilege of hosting subject matter experts, industry leaders, and even regulators who have shared their insights on topical issues around fintechs and startups. In today's session, we believe that, like our previous sessions, is still going to be engaging and insightful. So I encourage you to sit tight and enjoy this ride with us. Today, we have with us a man who is an expert in taxation. Is none other than Mr. Kenneth Erikume. Kenneth is the country operations partner of PwC Nigeria, and he leads the tax reporting and strategy team in the West African market. It covers Nigeria, Ghana, Liberia, and Sierra Leone. He's also a member of the PwC Africa Governance Board. Kenneth has over 21 years of experience in strategic tax advisory across Africa. He's a fellow of the Chartered Institute of Taxation of Nigeria, a former indirect tax faculty member of CITN, and the former vice dean of the extractive industry faculty. He is also a fellow of the Institute of Chartered Accountants of Nigeria and holds a certificate in international tax treasury management from the Association of Corporate Treasurers, UK. In addition, he is a certified insolvency practitioner in Nigeria and has supported numerous multinationals in balance sheet reorganizations, mergers and acquisitions, liquidation support, and other corporate restructuring mechanisms. Kenneth obviously has several feathers to his cap, and so we make welcome Kenneth Erikume to this session. Kenneth, thank you for joining us.
Thank you, Agbada, for inviting me, and it's indeed a pleasure to be here to engage with your clients and anyone who's joined in online.
Thank you, Kenneth. So let's kick off this conversation with a background about your professional career. I mean, can you please tell our audience why you chose a career in tax and not any other field?
Yeah, so very good question, Agbada. So in university, I studied biochemistry. And coming out of, coming out of the university, studying biochemistry, I looked for a job in FMCG. And the first job I got was in a pure water manufacturing company. And they weren't paying me a lot of money. They also, when I started on the first day, they mentioned that I was going to be working on Saturdays as well. And then, I just decided that that wasn't for me. Luckily, I had written the test to join PwC at the time. And they invited me for an interview. So I went for the interview, and then I joined PwC. Since my background was in biochemistry, I had no idea what accounting, audit, and tax was. I was just smart enough to get through the test and the interview. So they put me in tax, right? And, joining PwC at the time audit was very attractive and most people were in audit. So I sort of felt bad, but I said, let me try out my hands in tax. So I did it the first few months, and then I found out it was very interesting and that every day there is a new thing. So I've been there for more than 21 years now, and there is no looking back.
That's a very interesting career movement. Of course, you've also indirectly told us that tax is paying a lot of money. Tax is paying you a lot of money.
I don't know about a lot of money, but it's paying some of the bills. I can say that for sure. So it's a good career choice, to be honest. And I don't know, it is providence, it was sheer luck. But as you can see in the current tax landscape, there's been a lot of reforms, which means that there is even a business case for more consultancy in that space. So I think I made the right choice at the end of the day. And my bank account isn't bad as well.
Thank you for that honesty. All right, so let's make progress. In the audience, a lot of people may not be as fortunate as you, or a lot of people may not have a background in taxation. So to even start with, can you explain to our audience in a layman language what taxes are, what taxes mean?
Yeah, there is someone who said that taxes are the price you pay to be part of a civilized society. Now, I think that that explains it broadly, but let's unpack what that essentially means. You need to organize any society where you bring a community of people together. You need to be able to organize them and have a sort of political structure. And within that political structure, you would also have vision, ambitions, and things that you would like to do. And you would then come together and come up with a budget. That budget could be split out into things that are capital in nature. So, for example, you want to provide infrastructure, you want to provide roads, you want to provide schools to educate the children in that community, and so on and so forth. It could also be revenue in nature, meaning that some people have to run the operations of that government, so you have to pay their salaries and the likes. Now, for you to run that organization or that community, and that community could be anything. It could be an estate community where the residents have come together, to cooperate. You now need to collect some dues from them in order to be able to meet up with that budget that you have come up with. That's essentially what tax is. So at a government level, government, helps to organize society, and the taxes are the instruments through which they do it. Now, unlike estate dues or resident dues, which is levied at a uniform rate across, different residents or in a community, taxes take a different form because you want to be able to levy people who are more buoyant more than the people who are less buoyant. So this is one of the innovations that came up many years ago to say, let us tax people based on their consumption. And to tax people based on their consumption is where value-added tax comes from. To say, as people are buying, different bags, depending on the type of bag that you can buy. You want to buy a Gucci bag, or you want to buy a bag at, the roadside market, depending on your purchasing power, at a constant rate of 7.5%, someone who is buying a Gucci bag from a premium store will be paying more than someone who is buying a bag at the roadside. Similarly, you now say, well, another way of doing it is to tax people based on profits. So if you're making massive profits, the percentage that you would apply will be the same with someone you're taxing who's not as big as you, making that much profit. But because you're taking a percentage out of their lump sum, it is commensurate with their earnings. So this is how the corporate income tax has evolved. And then you have things like pay as you earn that is progressive and so on. So government takes all of that money in different forms, different instruments they use to levy it on citizens and corporates, and then they use it to run government. In fact, in the most developed economies, the level of taxation is usually high, but there's also a certain demand from government to use the resources properly. This is why there are some times when you travel out of the country, you get to some jurisdictions or some countries, and NEPA doesn't seize light, or you never see a pothole on the road. Now, people are contributing and they are holding their government accountable. They're contributing their taxes, and then they're saying, well, I can't just drop this money because I worked hard for it. Government needs to be accountable and use it for what they said they will use it for. And I think that is the utopia of where tax can get you to if it is done properly in a civilized society.
Thank you very much for that explanation. It covers both the definition of what taxes are and the aim that taxes seek to serve in society. And of course, you did not leave out the fact that accountability in the utilization of tax revenue is key in encouraging compliance by taxpayers. Thank you once again. So we'll now move on to our next question. Now, you mentioned that you've been doing this for the past 21 years. That's over 2 decades. So in your experience, what are some of the challenges that startups face in tax compliance, and how do you think they can overcome those challenges?
Very good question, Agbada. And I'll focus on tech startups and fintechs generally. A lot of founders focus on selling their viable business product and gaining market share. And rightly so, because that is the objective. And tech startups, across the world have been solving important problems in society, whether it be, when the likes of Facebook came and created connectivity, Uber came and, disrupted the transport value chain. So, the founders usually have a vision, and their objective is to get that vision operationalized. And that's a good thing. But while they are focusing on that, a lot of these people may not have tax governance at the top of their mind. So usually, while they're pursuing all of these things, record keeping and even meeting the minimum level of compliance may not be at the back of their mind. So the lack of awareness of the compliance obligations and having proper tax governance structures is one of the big challenges that fintechs would usually have. Another one is that, especially in our environment in Nigeria, is the complexity of the tax laws. And because we have a federal system where you have the federal government, state government, and local government, you now need to be dealing with different people coming to collect all sorts of taxes. Now, this is one of the things that the tax reforms is trying to address, and it addresses it at some level with the development levy that consolidates different federal taxes, but it hasn't completely dealt with it because there are still other licenses and fees that are payable at the federal level, and engaging the people at the tax reforms, there's an objective to get there at the end of the day of consolidating federally collectible revenues. But even at the state level, you would obviously need constitutional amendment to ensure that the State House of Assembly limits the number of taxes that they legislate on. So the complex tax laws pulling these founders and fintechs and startups in different directions could be very disruptive for operations. So that is actually another big challenge. Another one is the aggression of the tax authorities. So the Nigerian tax authorities are also looking for revenue, and you know that the Nigerian government has been running a deficit budget for many years, and therefore, collecting tax revenue is priority for them. So when they identify someone and bring them into the tax net, they expend a lot of energy and aggression in trying to collect the revenue. So if I give an example, when I practice tax in South Africa, not everybody is audited. It's based on your risk profile. But in Nigeria, every single company that comes into the tax net is audited. And that creates administrative burden for tech startups, fintechs, and the likes. And then managing these audits, different multiple audits and investigations could be very difficult, especially with record keeping. So in that space, if your focus is developing the product, but you have not been keeping records of your expenditure as well as your income, then it becomes difficult to manage those audits. So for me, those are the challenges and pitfalls that I've been able to identify in that space.
Okay, thank you, Kenneth. I'm going to come back to you, but before I do that, I just want to let our audience know that if you have any questions, you can drop your questions in the chat box, and we'll take those questions as we go along. But back to the very robust response that you provided to the last question. Yes, it's very correct. So do you think that, for instance, involving a tax consultant or a tax lawyer, for instance, from the inception of business, even before the launch of a product by startups, can help address some of these challenges?
I think so, 100%. I believe so. And some of the businesses that have thrived in Nigeria today, the founders always knew that you needed certain types of skills, either at the board level or as support structures. And when you look at some of the successful multinationals that have operated in Nigeria, they've always had very good legal support. So I think it's important that, in setting up, these businesses, you think about the skills that are required, at the governance level and at the executive management level to bring in skills. And those skills may not be appointees or employees. It could be outsourced, where you retain a lawyer, a law firm, or a tax consultant to support the business through incubation. Because, unfortunately, the environment that we operate, there's a lot of people that are looking at the easy target and trying to extract as much value from the business, especially when capital comes in and there is funding, and all of a sudden, because the company did not deal with compliance obligations in the past, someone sees that as a money-making opportunity to raise revenue for government. Now, while tax is important, it's also important to manage it properly so that you only contribute your fair share, right? And avoid things like penalties and interest, which are avoidable, and even optimizing your structures to ensure that you've set up your business in a way that the tax that is paid is optimized. So I think it's important, and I agree with you, Agbada.
Okay, thank you. Of course, the new tax laws, everyone has been talking about the implications of the new tax laws, and you'll agree that it would affect almost every business sector in the country, almost everybody in the country. So with respect to startups, what are some of the new compliance obligations that you think they would need to, be aware of under the new tax laws?
All right, that's a very good question. So one of it, especially if you're in the fintech space, but generally, is that when you're transacting with people, you have to ensure that you have their tax ID. And this has been in the news, and if you've been following the news, the requirement to have a tax identification number to operate an account with banks and other financial institutions is very paramount. And without that tax ID, you then have to close those accounts that people have set up with you. There's also an extended requirement that for people in the finance institution space, every transaction they carry out and every counterparty they have, whether it is suppliers or whether it is customers, those people actually have tax identification numbers. And I think one of the big controversies then was, what if the person doesn't have a tax ID? And the chairman of the Presidential Committee on Fiscal Policy and Tax Reforms mentioned that there is a project that is ongoing which would allow for the national identification number or BVN of those counterparties to be acceptable as documentation. So it's something to watch out for in terms of the new compliance requirements. Now, if you are in the financial institution space, another thing that's required is the submission of quarterly returns of individuals and companies that transact through your platform. So for transactions for individuals, the threshold is 25 million per month. So once it's 25 million and above, you have to report that transaction for any individual who operates an account with you. And then for companies, if the transactions cumulatively in a month is 100 million, you have got to report it. And that reporting is on a quarterly basis. And if you do not meet those reporting requirements, then you can be significantly penalized for not meeting up with those obligations. So that's another important compliance obligation that has been set up. The other one is that your compliance, your corporate tax returns, your value-added tax returns, your withholding tax schedules, which are already in place right now. Those things you have to continue filing them and filing them on time. One of the big compliance penalties to watch out for is withholding tax. The penalties for withholding tax has been increased to 40%. So if you deduct tax and you don't remit it from your suppliers, or you don't deduct and you don't remit, the penalty has moved from 10% to 40%. So managing your compliance as it relates to deducting withholding tax becomes very crucial as well. There are some other minor compliance requirements. For example, the requirement that if you go into an arrangement for tax planning, that you should disclose that voluntarily to the tax authorities has also been introduced. So there's quite a number of compliance requirements that startups need to watch out for. I've tried to give some highlights, and it's not exhaustive, but those for me are the ones that jump out that I think, people participating in this forum need to have in their spotlight and ensure that they have processes to manage.
Okay, thank you very much for that response. Of course, we can't unpack everything under the new tax laws, even as it relates to compliance obligations for fintechs and startups. But what I found really interesting about the response was the fact that, there's a project in the offing which would allow NINs to be used as a substitute for the tax identification number. I mean, that's important, that's necessary, and we hope that by January, when these laws kick off, we would have had that in place. Okay. As it is with all business arrangements that are set up for profit making, the goal is to scale and to expand. And startups have been doing that fairly well in Nigeria. So we've seen expansions, growth, whether in the sense of providing exporting services to outside Nigeria or setting up subsidiaries in other countries. So the question I have for you is, under these new tax laws, how, will the global income of startups that are sourced from all the operations be taxed?
A very good question, Agbada. So if the entity has been set up in Nigeria, if the group has an entity that is set up in Nigeria, and I'm assuming that we're talking about Nigerian startups, so it's very likely that the main or the first time they set up was a Nigerian company, and then they start earning profits from the export market as well. So maybe they have subscribers outside or customers outside of Nigeria. Then everything would be brought into Nigeria and taxed in the hands of that Nigerian company, right? There are some exemptions that have been granted, corporate tax exemptions that have been granted to exports as well. So it's important that, startups and tech companies understand that if they are providing services from their Nigerian company to operations or customers in other jurisdictions, the profits relating to that export market can be fully exempted in Nigeria. So while you're supposed to bring everything into scope from a Nigerian perspective, from a corporate tax perspective, the export profits is exempted. Now, the other thing to also note is that if you optimize from a tax perspective by ensuring that you drive the effective tax rate below a particular level, the new legislation imposes a 15% minimum tax. And that 15% minimum tax would apply under two conditions. Number one, if the revenues of that company is more than 50 billion, or two, if the company is part of a multinational enterprise group that the consolidated revenue is more than 750 million euros. So those thresholds are quite high, but it's important to watch them. That even if you optimize, take advantage of tax deductions, take advantage of incentives, and the effective tax rate drops below 15%, the new law says that you have to top up the tax to bring it up to 15%. So there is no real incentive to optimize below 15% effective tax rate.
Once you meet the threshold.
Once you meet the threshold, if you're below the threshold, then it's not really a problem. You can optimize as much as you want. The other thing I think is important to mention, apart from this 15% minimum tax rule, is that if the company sets up a foreign entity, so let's take, for example, you set up an entity in the Cayman Island, or you set up an entity in Mauritius, there is that new rule that says that a Nigerian company is not just a company that is incorporated in Nigeria, but also includes a foreign company that is centrally managed from Nigeria or effectively managed from Nigeria. So if you have a group structure where you have a Delaware company at the top or a Mauritius company at the top, and the board members are all sitting in Nigeria and board meetings are happening in Nigeria, then that is considered to be centrally managed from Nigeria, and that company will be taxed in Nigeria. Or if the board sits elsewhere, but all the people making decisions on that company are located in Nigeria, then that means they are effectively managed in Nigeria, then that company will be taxed in Nigeria. So it's important to understand the rules around central management and effective management and how it would impact, companies that have been set up within the group structure overseas in order to optimize from a tax perspective. So these are some of the considerations I believe would impact global expansion and the considerations around global expansion.
Okay, thank you once again for that insightful response. I think that the introduction of the POEM rules, place of effective management, is one of the significant changes that were introduced under this new regime to protect the Nigeria's tax base from erosion. So in 2022, if I'm not mistaken, the Startup Act was enacted by the Nigerian government. That act, amongst other things, provides certain incentives for startups. But you know that you and I know that the new tax laws, particularly the Nigeria Tax Act, repeals not only the principal tax enactments in Nigeria, but also the fiscal provisions of other laws like the Startup Acts, the PIA, and others. And the concern some people have expressed is whether this repeal will affect the incentives that startups have been enjoying under the Startup Act. So can you please tell our audience if the incentives under the Startup Act were reenacted under the new laws, and if so, to what extent have those incentives been retained?
Yes, unfortunately, it wasn't retained completely. So it was migrated to an extent, especially for the investors. But for the company itself, it wasn't completely migrated, which is the pioneer status that allows for the extensive tax holiday was not migrated. So let me start with the tax holiday. Now, if you're a tech startup and you've already gotten the pioneer incentive, there is a provision in the Nigeria Tax Act that allows you to enjoy the benefit even into 1st January 2026, up to the expiration of that tax holiday. So you only benefit from the pioneer status as long as you have it, before 1st January 2026. You can then take the benefit for as long as they've granted it to you into the new tax regime and continue to benefit from it within the new tax regime. So there is a provision that safeguards the incentive if you already have it. But going into 1st January 2026 and you're a startup that has not gotten an incentive, the pioneer incentive, and you want to apply for it from 1st January 2026, it is no longer available automatically. You have to go and look at the Economic Development Incentive List, which is a list that has the priority sectors that government wants to incentivize, and check whether the business that you're providing qualifies for that economic development incentive. Now, the economic development incentive operates differently from pioneer status. Pioneer status is a corporate tax holiday that gives you exemption from tax on your profits. But the economic development incentives gives you a 5% tax credit on your investment in qualifying expenditure. So if you involved in research and development, or you're involved in purchase of fixed assets, whatever you invested in that space, 5% is then available as a tax credit for you to deduct against the income tax that you compute within the new tax regime. So there is opportunity to benefit from that economic development incentive scheme if the nature of the business you're doing is defined as one of the priority sectors. But if you already have pioneer status, you continue to enjoy it into the new tax regime until it expires. Now, for the investors, the protection for investors is carried on into the tax reforms. So the capital gains tax, first thing to note is that capital gains tax no longer exists. It's now a broad 30% on whether the profit is revenue in nature or capital in nature. So capital gains tax from 1st January is at a higher rate of 30%. But gains from disposal of assets by an angel investor, a venture capitalist, a private equity fund, accelerators or incubators in a labeled startup, which is held for a minimum period of 24 months, are exempted from, the tax on capital gains. So an investor that invests into a labeled startup can dispose of the shares without any taxation as long as they've held those shares for at least 24 months. But it must be a labeled startup. So those incentives, that particular incentive has been preserved and taken into the tax reforms. But there are other incentives apart from the economic development incentive I mentioned. So if the fintech or the startup, exports its services, so let's assume you have a startup that exports into Ghana the services, those will be zero rated for VAT purposes, which means that, the expenses that the company incurs to provide those services, the VAT they incur, is recoverable from government. The other thing to mention is that, there's a tax deduction of 5% of turnover where the startup is investing in research and development. There's also a 50% withholding tax rate reduction on services paid to foreign consultants, management, technical and professional services providers to labeled startups. So labeled startups don't have to deduct the normal 10% or 5%. They deduct half of the relevant withholding tax rate when they are making payments to foreign consultants for management, technical, consultancy, and professional services. And then the final thing is that if you have a tech company or a startup, particularly in the tech space, that employs the services of an individual outside of Nigeria, that individual will not be taxed in Nigeria. So those are some of the incentives that, fintechs and startups need to watch out for and take opportunity of within the tax reforms.
Thank you. It's reassuring to know that there are still a lot of incentives for startups. But just a brief comment is, just to mention that this again underscores the need for startups to have tax consultants and tax lawyers by their corner so that it can even identify what incentives are available to optimize their tax positions. But let's start off from where you stopped, which was that where a labeled startup employs persons from outside Nigeria, those employees would not be subject to tax in Nigeria. Would that apply to remote workers, I mean, who are Nigerian residents, or is that available only to non-Nigerians?
Yes, so very good question. I think it's so once you employ someone who is resident in Nigeria, then automatically that person will be taxed in Nigeria. So whether that person is Nigerian or foreign, but once the person is a resident in Nigeria, then that person will be taxed in Nigeria. So it's only available to people who are non-resident. Now, the problem is, and one of the reasons why, to your comments that you really need a technical support is that, in the course of the debate over the various iterations of the act, there have been different versions. Even though the objective continues to remain the same, that government wants to allow Nigerians to be able to employ non-residents that without bringing them into the Nigerian tax net. There have been different versions. Where the non-resident is not Nigerian and the employment duties are not wholly or partly performed in Nigeria, the reading now is that employment income will not be taxable. Employment income for that person will not be taxable in Nigeria. Where the non-resident is Nigerian, so the person is in the US, but the person is Nigerian, and the employment duties are not wholly or partly performed in Nigeria, the income will only be subject to tax in Nigeria where the income is exempt in the US, in the host country. So there are some nuances that you need to watch out for. And we also expect that the tax authorities will come up with guidelines and clarification on this matter. So, while the exemption exists, it is not, a silver bullet automatic scenario. You have to carefully read the provisions of the law and ensure that, whoever that non-resident skilled worker is providing support, they meet the conditions in the law.
Thank you for that very clear clarification.
a clear clarification.
All right. So we have mentioned the need for technical support and all of that, but do you think that there are some structural organizational barriers that can affect the ability of startups to even benefit from these incentives?
I don't think there is one big sledgehammer organizational barrier, that is unique to tech startups that would prevent them from optimizing the tax benefits. I think, like I said earlier, one of the important things to consider is that tax be included in the governance structure. So you need to have tax as a strategic conversation within the governance, engagements that happen. Because the difference between, a startup that is going to survive into the future and a startup that is going to struggle depends on how they are able to optimize all the capital that they've been able to generate. And one of the things to do to, one of the ways to do that or enhance that is to enhance value both for the shareholders, the investors, as well as from the company, not giving away what the law did not even plan for you to give away. So I've highlighted several incentives, but do you have the governance structure that allows people to focus on it within the organization and claim those benefits? Another gap is also the lack of a dedicated tax function. And it's not compulsory that you must have an in-house tax function. You can have the in-sourced model or the outsourced model, where you engage the support of a consultant or a law firm to actually help with keeping an eye on some of these priorities. So for me, I think that those are the two things, the focus of the governance team on optimization and also having the management and operational structure. And that management structure does not have to be internalized or in-house. It can also be outsourced, to others. One of the things we learned in management accounting is risk and how to manage risk. You can retain risk or you can share risk. One of the ways of sharing risk is to get an insurer to take some part of the business risk. And it's exactly the same in taxation, that you can share risk and opportunities, because the opposite of risk is opportunities, and ensure that you get the right outcome by getting or gathering the support that's required.
Okay, thank you very much. We already have some questions in the chat box, so maybe we'll just run through a few of those questions before I return to you. So someone is asking, are small fintechs with low revenue still required to pay tax?
Good question. Very, very good question. Low revenue. There is a threshold of where you will cross that you'll be required to pay corporate income tax and be required to register for value-added tax. So what's that threshold? For the corporate income tax, the threshold is 100 million and above. So once your revenue is more than 100 million or 100 million and above, that is when you pay corporate income tax. If your revenue is below that, then you don't have to pay any income tax on your profits. You'll be fully exempted. Now, for VAT registration and charging VAT on invoices, it's only required if your revenue is 50 million and above. If your revenue is below 50 million, then you're not required to register for VAT and charge VAT on your invoices. So those are the thresholds. But the VAT exemption and the corporate tax exemption does not preclude you from your other tax obligations. So you could have tax obligations to pay, payee on your staff salaries. It doesn't preclude you from doing that. You could have obligations to deduct withholding tax from suppliers. It doesn't preclude you from doing that. So it's important that you understand, the exemption that, is afforded to you based on those thresholds, and still understand what your, continuous obligation, continues to be, even though you do not cross those thresholds. So there's good exemption for, companies who have not scaled up in terms of revenue.
Okay, Kenneth, thank you for that response. But the next question, when you started off, you mentioned something about accountability on with respect to the utilization of tax revenue and how that can boost the confidence of taxpayers to comply with their tax obligations. So here we have a question that says, how do we effectively hold our leaders accountable for the taxes collected? Most Nigerians are tax averse due to this inefficiency. So what are your thoughts?
That's a tough question. That's a very tough question. I think so let me attack it from this angle that one of the things we really need is everybody to contribute. Yeah. When you have that critical mass, it's now easier for everybody to come and hold the government accountable. What tends to happen now is that, some people are complying, some others are not. Some people are complying partly, and they are happy to take from their money and, provide themselves the amenities. Yeah. Even though they're not paying the right amount. Yeah. By the way, not paying the right amount and completely evading tax is illegal, by the way, right? And thinking about it, no country developed by not paying taxes, except maybe the likes of UAE. But you need to have a lot of natural resources and very few in terms of population for that to happen. Yeah. So we're not in the position of the UAE. Would like to think we are there, because we always talk about our oil revenue, but we are not there. Okay. So I think it's important that we get to a place where everybody contributes. Now, what government is doing, you remember I mentioned the data that banks and other financial institutions need to submit. Government will get data from that. The requirements that you don't transact with anybody without a tax identification number, government will get data from that. There is this fiscalization that is currently happening where, the FRS has introduced e-invoicing. The idea is to have a view of all economic activity within the ecosystem. Sales being made by somebody is actually an expense for the other person. So having a full picture. Now just think about building a database and an analytical engine that is able to, take all of this information and attribute it to Agbada's transaction, that Agbada has now sold property in Banana Island. He has an investment in shares that he sold, on the Nigerian Stock Exchange. He has several bank accounts and all those things. Government will then be able to profile Agbada and be able to say Agbada should not be paying 5,000 naira tax. He should be paying 20 million and above, as an example. I know I reduced the tax you're supposed to pay, Agbada, but this is all hypothetical. Now, when that vision of government, if government is able to make it materialize, then there'll be no hiding place. Everybody will contribute. Now, what we've seen in some jurisdictions is that, and most of the revolution we've seen were from a push from taxation. So there was a time where, stamp duties was introduced on sugar, right? In the US. And incidentally, it's always women coming together and always about tax, that they insisted that they will not pay tax without representation. So I think at that point where everybody sees that, okay, we are all paying, but there is pothole in front of my, as I'm driving from the front of my house, my sentiment is the same as your sentiment, and everybody's sentiment will then be more coordinated to put the government under pressure and hold them accountable. So your representatives in the National Assembly will not be having a field day, relaxing and enjoying life, but they'll be having community pressure consistently of people demanding for good governance and effective use of resources. But that is, theoretical. It is yet to be seen whether that's what is going to happen. But, that is ideally what should happen when everybody's contributing their fair share. There are some jurisdictions that they don't pay, they don't pay school fees, they don't pay hospital bills, they don't pay anything. All of their taxes are used. So if you go to Norway, for example, Norway is so transparent. If there is embezzlement or fraud, immediately the prime minister would have to resign because people are paying upwards of 40% taxes. University, secondary school, everything is free. Healthcare is free, but they keep very little in terms of, disposable income after collecting taxes. So there has to be a compromise. What do you do in terms of the right tax instrument? But I mean, I think it is largely academic. We now need to see practically what the outcome would look like.
Well, I agree. And my personal view is that while the utilization of tax revenue has not been so efficient, that would not provide a valid basis to evade tax. So the option is pay taxes, which would, of course, give us every justification to demand accountability and efficiency. So let me just take one more question. So this person is asking, for fintechs with parent companies abroad, what are the core compliance requirements to note?
All right, very, very good one. I think the first thing is you need to be aware of the central place of management and effective place of management rules. So when you talk about parents, are those parents fully in charge, or was it a few people in Nigeria that came together and set up a Delaware structure to hold their Nigerian company? So those two things could have different considerations. So where it is a Nigerian tech company with Nigerian founders sitting in Nigeria, but they went to set up a Delaware structure, it's very possible that that Delaware company could be effectively managed from Nigeria, or even the board could be sitting in Nigeria. And that just creates a problem because that company will be considered to be that Delaware company will be considered to be a Nigerian company for tax purposes. So you need to be mindful of that and ensure that you revisit the do's and don'ts for operating the board and the executive management team so that you do not create Nigerian tax liabilities. So that's the first consideration. The other consideration is to also, if your revenue is below 50 billion, but it's very possible that that foreign parent is part of a multinational enterprise group that the consolidated revenue is more than 750 million euros, in which case you need to keep track and ensure that your tax liability does not give rise to an effective tax rate that is less than 15%. So those for me are the most critical considerations. There is other considerations as well. If it is not a labeled startup, it means that when the investor is exiting, right, they will be paying tax at 30% on the capital gains that they earn from the disposal of shares. So one of the ways of managing that is, and this is complicated, by the way, is to look at whether you can interpose an intermediate holding company in a jurisdiction that limits Nigeria's taxing rights. That means there's a treaty, and that treaty limits Nigeria's rights to taxing the disposal of the shares of that company. That way, the investors don't have to pay the Nigerian 30% corporate tax on the disposal of those shares. But implementing that is quite complicated. So you really need to be sure that there is going to be benefit before you go into that sort of restructuring.
Well, I mean, I like the last point that you just made. And again, because even under double taxation agreements, there is this PPT test that you need to pass. So, I mean, companies, startups would definitely need to be creative and, be careful on how they work around those kinds of arrangements. Now, so your responses have been very robust, very comprehensive, almost exhaustive. But it's almost impossible for us to be able to unpack everything under the new tax laws as they relate to startups. But do you think that, I mean, apart from these issues that you have highlighted, there are other aspects of the tax laws that startups should be aware of?
All right, that's another very good question. Again, because there are so many things, I will first of all start with the change in the rules as it regards VAT. So currently, when you incur expenses, the VAT forms part of the cost. So let's assume PwC is providing advisory services and PwC charges 100. There is going to be VAT of 7.5 on it. So we charge 107.5. Okay. That 107.5 will be expensed currently as consultancy expense.
Mm-hmm.
Under the new rules from 1st January, the VAT on that service will now be recoverable. So you can claim it against the VAT you charge your customers. And if your output is 0 rated, you can ask the government for a refund. And that refund is not onerous. They just need to give it to you within the time frame. And if not, you can offset the VAT against other taxes. So I think that's one of the important provisions I think I need to highlight. There's also the intention that the corporate tax rate of 30%, and it's not in the acts right now, but there's something in the law that allows the president through an order to reduce the corporate tax rate from 30% to 25%. So there's actually a plan that to reduce the corporate tax rate from 30% to 25% in the future. There's also a plan to increase the VAT rate, because now that VAT is recoverable without an increase in the VAT rate, government revenue is going to drop significantly from the VAT angle. So there's going to be a significant dip in VAT revenue. And one of the reasons why they are doing the fiscalization and e-invoicing, so that they have more visibility of transactions. Now, in the future, there's still a plan, even though it's not in the law, but there's still a plan, and in order to ensure that there is alignment with other countries within the ECOWAS region, to increase the VAT rate gradually from 7.5% over time until it becomes 15% and is aligned with other countries like, Cameroon and Ghana. I think the final thing, those ones are intentions, but there's something in the current law that for virtual or digital assets, they cannot offset losses offset losses from trading in, say, Bitcoin and the likes. They cannot offset those losses against profits from other assets. The effective tax rate of 15% is also something that I think I've mentioned already, and e-invoicing. Invoicing is one of the places where I think the tax reforms is not just introducing an instrument for tax reforms in terms of opportunities and risks, but also a play with regards to the product that fintechs and startups should be looking at. So the invoicing allows you to get data around, what the sort of invoicing pattern of companies are and how they are being paid. So in an ideal world, the invoicing solution could be synced with people who play in the credit space. Why? Because you can then predict, properly what the time frame for invoices, for the payment of invoices would be. So if you're playing in the space around factoring or invoice discounting and the likes, then, it makes sense for you to combine and think about playing in that e-invoicing space as well, in terms of being a systems integrator or being an access point provider. So that's one that, it seems like there's a business opportunity there. And earlier this morning, I had some conversations with some guys in India who are actually looking at coming into the Nigerian market and playing in that e-invoicing space. So there's a lot. I don't think we should look at it purely from, my compliance, my tax obligations, my tax incentive. You also need to look at it from a strategic perspective. What am I doing? What does these tax reforms introduce that could give me leverage in terms of my business? That's one angle. The other angle is, do I even modify my business approach completely based on the tax reforms? Should I accelerate my pioneer status so that I get pioneer status now, because it doesn't expire when the tax reforms kick in? There are incentives for exports. So should I look not just at the Nigerian market, but also look at other markets and optimize value in that regard? So let's not look at it operationally. Let's also look at it strategically of, whether there are areas we can change, both from our holding structure and to our, in terms of our business value chain, that we can optimize the benefits of the tax reforms.
Okay, another brilliant response. Would at this point run through the questions, some of the questions in the chat box again, and let me apologize in advance that we may not be able to address all the questions that you have, but you can reach out if you have any additional questions, or you feel that your question was not fully addressed, and we'll be more than happy to provide further clarifications. So, Kenneth, someone is asking about the nature of transactions that are subject to withholding tax.
Oh, is that the question?
Yes.
Oh, okay. That one, I'll say there are resources online that will show you the various transactions, but let's start with passive payments for passive income. So dividends, interest, rent, royalties, if you're paying all of those are liable to withholding tax. You need to deduct withholding tax at 10% from all of those: dividend, interest, rent, royalties. Okay. Now, from 1st January 2025, remember, I'm not saying 2026. So 2025 is already past, almost all transactions are liable to withholding tax, right? Almost all. So it's either it's going to be 2% if you're deducting from a trader in goods, or it's going to be 5% if it's a domestic supply of services, or it's going to be 10% if the supplier is non-resident. But there is a breakdown because, I've tried to simplify it. The only time where you probably do not deduct withholding tax is if it is a transaction where there is no opportunity to withhold. So let's assume you play in the fintech space, right? And you're supposed to pay commission. But the person you're supposed to pay the commission collects the money in advance on your behalf, right? So let's assume, for example, you are an insurer and you use InsurTech, and then there's a platform that collects the money and gives you your net premium and keeps the commission. Normally, if they paid you your gross premium and you're paying the person commission, you would have deducted withholding tax. But because the person collected the money and gave you the balance, there's no opportunity to deduct. So in that regard, you're not expected to deduct withholding tax. So those are some of the types of transactions. And then there are exemptions. There are some exemptions, for things like telephone bills, insurance premiums, and so on, that have been granted full exemptions. So it's important to go through that list. It's not something that can just be said to you immediately. Remember when we were in school, there are some exams that will give you the table, to refer to. That's how you do it in terms of withholding tax. And I'm sure Agbada can share some of those resources with you if need be.
When you mentioned table, it reminded me that you are first and foremost a biochemist.
Absolutely. I know, Agbada, you're a law. Your first degree was in law, right? So in law, they will give you no reference material, I'm sure.
All right. So, there is another question that I would love you to share your thoughts on. So how do tax obligations influence investor decisions in early stage fintechs?
Take that again, Agbada.
How do tax obligations influence investor decisions in early stage fintechs?
Difficult to say, right? Depends on the investor. There are some investors that, for them, risk is a no-no. So they like certainty. So if you remember, and this is not this industry, but if you remember when we had the petroleum industry bill for several years, it stopped investors from bringing in money because there was no certainty around the tax regime that would be at play. So they withheld their investment. And for many years, a lot of the expansion that needed to happen in terms of the oil and gas assets didn't happen, because investors were just wary of the uncertainty around the environment. So with these tax reforms in Nigeria, at least that gives certainty. They know that this was an overhaul of the tax regime. It happened quite quickly, right? And therefore there's going to be stability in the tax regime into the future. So it gives them some comfort. But they would also be skeptical about not really skeptical. I would say they would also be considerate or think about the new capital gains tax regime, especially if it is an equity investment and it's not into a labeled startup. Then it means that when they are exiting, it's very likely that they'll pay 30% tax. But I would advise that those investors also look at the various incentives within the tax reforms. For example, the economic development incentive, the incentives for exports, even the ability to claim VAT on expenses. When you look at all those things, I did a simulation for a fintech. It's a large fintech, to be fair. And I did the analysis for a very large fintech, and it seemed like the tax numbers were net positive. When I say positive, it was net beneficial to them from an operational perspective. So when the investors looked at the 30% when they are exiting versus the optimization which they're able to get at the investee company level, they were still comfortable, around the viability of their investment. So it depends. I think certainty is important, and simulation of the tax effect is also important before those investors reach a conclusion. So that's how I will answer it, Agbada. It's a very tough question.
I agree. I agree. It's a tough one.
It's open. Yeah.
So at this point in time, we'll just ask a few questions to wrap up the session. And I mean, first and foremost, are you a music lover?
Interesting question. Yes, I enjoy music quite a lot. The problem is I never remember all the lyrics. Sometimes I don't remember the title, but I do enjoy my Spotify quite a bit. So yeah.
I
Yeah.
think we are in the same WhatsApp. So so if this session could be summarized into a song, what song do you think it will be? Given
For
how insightful, enlightening, and
yeah.
engaging it has been so far, what song do you think it will be?
So, Agbada, I told you that I forget the lyrics of the songs and I forget the titles of the songs. But give me one second to think.
Okay.
Maybe there's this song that says, "I came in like a wrecking ball."
Oh,
I can't even remember who
that
sang it.
was
Wrecking Ball. Yeah.
oh, I remember.
And
Sorry.
not in the negative connotation of that
I
song,
can't,
but in terms of
I can't
how,
remember. I
yeah.
can't remember. I know the song, but
I'm
I
going
can't remember.
I'm going
Oh,
to
so it's
Google it. Don't worry.
actually Miley Cyrus. Miley Cyrus.
Miley Cyrus. Yes,
I think
indeed.
that's the only song of Miley Cyrus that I actually know.
Yeah.
Um, okay, so if you had the opportunity to unplug from the chaos of daily emails, daily meetings, daily calls, right? If you had the opportunity to just unplug for 24 hours, how do you think you would spend it?
Yeah, there are two things I would love to do. First one is take my wife out for dinner in a nice restaurant. I love that. I love that. The other thing I would like to include in it is hanging out with my daughter. So I have 3 kids. My daughter is the last. So I love hanging out with her. I enjoy how she's evolving. Her sense of humor she's just discovering her sense of humor. And then I really enjoy our chat and the relationship. They always say there's that relationship between the father and the daughter. So I think we do have that. And maybe a bit of golf as well. Even though golf is one of the games that has frustrated me quite a bit because the time to do it, I don't have enough of it. And then I play well some days, and then I play crappy golf some other days. So if I can combine these 3 things into that 24 hours, it will be fantastic.
Oh, beautiful. I was grinning from ear to ear when you were answering that question. And of course, it shows that even with all the responsibilities from work, you still have time for the things that truly matter. I actually remember a few months ago when we were on the phone discussing the Supreme Court decision on the lottery decision by the Supreme Court. That then they just I mean decided the appeal, and we're discussing, and I could hear the voices of the other people at the background.
Absolutely.
Right.
Absolutely.
So
Those are the people I'm working for.
yes. All right. So you are a role model to a lot of people. You are an accomplished tax practitioner. So can you please tell us one habit or a particular mindset that has helped you so far?
Yeah, so I think hard work. I mean, there's no replacement for hard work. So you've got to be diligent in whatever you do, because that's what's going to give you the sustainability to ensure that your career is long and fruitful. So hard work. So within all of this, I have to find time to read the new tax law. I need to find time to listen to podcasts on The Economist, read articles, compare notes. If you remember, on that Supreme Court decision, I was the one that called you, right?
Yes.
Um, on that matter as well, to sort of check what your views were. Or was it the other way around? I can't remember.
No,
But I
I
know
think
I've
I think you did the calling.
yes, yes. So we've, it's about also seeing what other practitioners are doing, getting perspective from experts, and staying humble because it's a privilege in terms of where we are today. It's not just about the diligence, but also about the opportunity, the time and chance of it, and the provision that God has provided to us to experience all of this. Not everybody was lucky to experience all of this. And I know it's not, one of the things is the fingers are not equal, so I'm not exactly one of the people at the top in Nigeria. But what I do, even though this seems to be the smallest here, what I do adds a lot of value to people, and that gives me satisfaction. So just staying humble and remembering your roots, and also ensuring that you're giving back as much as you can. I think those attributes are what has helped me in advancing in my career.
Thank you, Kenneth. Staying humble, staying grateful, and finding satisfaction in what you do. Thank you once again. This session has been very helpful, very insightful, and engaging. I promised at the beginning that, it's going to be worth the while. And I think that I even understated the potentials of the session at the beginning. So thank you once again for finding time in your very busy schedule to join us for this session. And to our audience, thank you for your time. Thank you for joining. We hope that there will be more opportunities for collaboration. And I wish you a very productive week ahead until we catch up again next time.
Bye.
All right.